The history of Japanese candlestick charting patterns lets of a bit of knowledge about candlestick patterns. Candlestick charts originated in Japan during the 18th century. Since no outlined currency normal existed in Japan during that time, rice represented a medium of exchange. Various feudal lords deposited rice in warehouses in Osaka and would then sell or trade the coupon receipts. Therefore rice became the first futures market. Within the 1700s, legendary Japanese rice trader Hamamune Hisa studied all aspects of rice trading from the fundamentals to promote psychology. Hama subsequently dominated the Japanese rice markets and designed an enormous fortune. His trading techniques and principles eventually evolved into the candlestick methodology that was then employed by Japanese technical analysts when the Japanese stock market began within the 1870s. The methodology was picked up by famed market technician Charles Dow around 1900 and remains arguably the most in-style type of technical analysis chart in use by nowadays traders of monetary instruments. Why do we use candlestick charts? Candlestick charts show the same information as bar charts, however in a very graphical format that gives an additional detailed and accurate representation of price action. Candlestick charts visually show the supply and demand situation by showing who is winning the battle between the bulls and therefore the bears. Candlestick charts reveal another dimension of the given period's price action by pictorially displaying the force, or lack of force, behind each price bar's movement. Candlestick formations create all single-bar and multi-bar patterns considerably easier to identify in real time, so increasing your probabilities of catching high-chance trade setups. Similarly, because candlestick charts use the same information as bar charts, open, high, low, and close, all Western technical signals used on a bar chart can easily be applied to a candlestick chart. Candlestick charts offer everything bar charts do and more. Using them may be a win-win situation because you will use all the trading signals normally used on bar charts with the added clarity and additional signals generated by candlesticks. Candlestick charts are more fun to look at. Now let's head over to the anatomy of a candle. Candlesticks have a central portion that displays the price distance between the open and the close. This space is called the important body or merely the body. The value distance between the open and the high for the amount being analyzed is termed the higher shadow, generally known as an upper wick. Still, the highest worth purchased explicit period is the marked by the high of the upper shadow. The price distance between the close and therefore the low for the amount being analyzed is called the lower shadow, typically referred to as the lower wick. The $64,000 body displays the gap and shutting price of the security being traded. Closing costs have added significance as a result of they confirm the conviction of the bulls or bears. If the security closed higher than it opened, the important body is wider unfilled, with the gap value at the underside of the important body and therefore the closing value at the high. If the protection closed below it opened, the $64,000 body is black, with the opening price at the top and also the closing worth at the bottom. Depending on the price action for the period being analyzed, a candlestick may not have a body or a wick. To highlight or visualize worth movements, trendy candlestick charts, particularly those displayed digitally, typically replace the black or white of the candlestick real body with colors such as red for price that closed lower than the opening price and blue or green for price that closed higher than opening price. There are multiple forms of candlestick patterns. There are two patterns that are the most common to know for those involved in trading forex and stocks. The two candlestick patterns are namely bullish candle and bearish candle. Let's look at the illustration. For bullish candle, it signifies that the closing price is higher than the opening price at a particular time frame. This signals an uptrend movement. The length of the candlesticks varies among different time frame. The longer the body indicates larger upward price movement. For bearish candle, it signifies that the closing price is lower than the opening price at a particular time frame. This signals a downtrend movement. The length of the candlesticks varies among different time frame. The longer the body indicates larger downward price movement.